Well, I'm really excited this morning to introduce to you to Mark Taucar, who's the Senior Portfolio Manager at Excellent Select. He's also a managing partner with the firm. And so without really any further ado, Mark is an active portfolio manager, discretionary, does a lot of advanced strategies to protect clients' money. So really, Mark, what I wanted to do today is start off really with the big picture. So it's always a good place to start, and then we'll progress from there. So kind of give me your big picture on the economics of the global economics and financial world, and then we can sort of transition into some more pointed questions from that.
Sounds good. Overall, we think that the global economic circumstances have some issues that we have to be aware and vigilant with regards to when allocating client assets. We've just come through the pandemic. Things seemed good as we started to open up markets. A lot of liquidity was being pumped into economies around the world by central banks via monetary policy, very, very low interest rates and loose lending policies. And then on top of that, fiscal policies around the world had reached unprecedented levels of stimulus that really saw the economies that were most affected by COVID be fairly resilient to what happened. And as a result, we've seen unemployment across the world bounce back very strongly. Here in Canada, we saw double-digit unemployment through the course of COVID, and then very rapidly, as we got a handle on the health implications to our healthcare sector and what it meant to the economy, we saw that there was some resilience, and with the support offered by the governments, we saw that the economy had come back. Unemployment dropped. In Canada here, we have the lowest unemployment that we've ever recorded since, I think going back to 1971, if I'm not mistaken, when these stats were originally started to be kept in the manner that they are. And then, of course, in the United States, similarly too, we see unemployment at historical lows. So all in all, if we just left it at that, people would think, well, great, fantastic, right? We have great unemployment. Unemployment is low. People are working. People are spending money. They've got a lot of money. But I hearken back to that one line, and I encourage anyone, if you have the time. Brilliant economist. His name is Milton Friedman, no longer with us, unfortunately, but you know what, you can go on to YouTube and listen to a lot of his lectures as it relates to the economy. And he has a great line, and the line is, inflation is too much money chasing too few goods. And so a perfect storm emerges. Think back to that movie, The Perfect Storm, where you have all these different storms collide to create this intense, very intense storm. And so very, very similar to that, we've had different circumstances collide on a geopolitical level, on a global economic level, to now exacerbate that one line, too much money chasing too few goods. Had it just been COVID, what you would have seen is that the spike in inflation, yes, we would have seen inflation come back into the system because economics is really a study of scarcity, right? And so scarcity also of money, right? And of money and of goods. And so just by holding everything constant, if you have more money and you keep goods at a constant level, well, then the price of those goods would tend to rise. But now we're not only just dealing with the supply of money, we're now dealing with the supply of goods. Okay, so that's now, we've had one storm being COVID. Now the next storm is the knock-on effect of COVID in certain regions around the world, which are essentially the manufacturing heartbeats of the global economy, being Southeast Asia, China. These are economies that essentially have been built on just-in-time manufacturing and supply chains that feed into large consumer economies like that of North America and Europe. Okay, so now what happens is if you have these economies affected by COVID, and the policy by the Chinese government and other governments in that area was to shut down full cities, well, now you have a supply shock.
Yeah.
And so again, going back, we have a greater supply of money, and we thought we would have relatively similar type of supply of goods, but now with manufacturing being shut down in certain parts of the global economy, now those goods, the supply of those goods has dropped. So it's now exacerbated the previous storm. On top of that, now we heap the fact that one of the largest suppliers of energy to the world is now in a war. Now, it's not a favorably looked at war with its neighbor, Ukraine, Russia and Ukraine. Russia supplies an enormous amount of energy into Europe, not so much here in North America, but certainly into Europe. And so now the problem here is no one wants the encroachment of a perceived enemy onto their borders. So NATO, of course, bristles its, the hair on its, the back of its neck stands up, and now they decide we're going to form a united front and support Ukraine. And lo and behold, now we've got sanctions placed on the Russian economy and a European bloc that's now looking for alternatives to energy that is coming out of Russia. How good they're doing at that is yet to be seen. Although, I might add to this that the European group of countries, the Eurozone, was on a path to moving towards less dependence on Russia. 5-6 years ago, they had great programs in terms of nuclear energy, which over the course of 5-6 years, we're starting to reduce because of the fears brought on by events at Fukushima. And then on top of that, their green initiatives, which were really focused on trying to generate energy through solar, wind, and low carbon emission generating initiatives. Well, that didn't pan out very well. And so lo and behold, what do you have to do? Well, you have to go back to the well, the one that you don't want to go back to, and get your energy from Russia. So the war and the reliance on energy has now caused this spike in energy prices around the world, which is no good for inflation. So now storm number 1, COVID. Storm number 2, supply chain issues. Storm number 3 is the effect of war in Ukraine on energy prices. And as we all know, the laptop that we're talking on, the cars that we drive, the tires that we drive on, the sealant that goes onto my driveway, the packaging that packages the goods that I buy. So much of it is reliant on what gets pulled out of the ground. And so now inflation becomes this beast, and lo and behold, what we have is a circumstance where employment is through, we've got the strongest employment, which means people are feeling good, they want to spend. Prior to that, these same folks were given money from the government through various initiatives to keep them spending, keep the economy going. Now we have energy prices escalating, so there's a lot more money. Now all prices are increasing, not just because of supply chain shocks, but because now input values into those products are starting to increase as well. And as we all know, if you run a business, at the end of the day, you still need to be able to make some money And if your inputs are increasing, well, then that means those people who are buying your goods are always going to have to pay a higher price in order for you to make some money as well. Lo and behold, what ends up happening now are that the governments around the world are now looking at initiatives to curb inflation. Central banks are starting to realize, hey, we can't have inflation this high, otherwise we're going to destroy the economy. The problem with that now is that what led to the fiscal circumstance and the monetary circumstance, so the position that we are right now in terms of balance sheets around the world, it isn't good because of all the debt spending.
Yeah.
That would have seemed to be an okay idea. We don't want economies to crash in times of pandemic. So yes, of course, we'll need to stimulate something. Well, now that extra debt has to be spoken for at some point, right? I'm never going to be able to go to you, Bill, and you provide me a loan and not pay it back at some point. That has to get paid back. And so with interest rates increasing, now the question becomes, well, what is the cost of that interest rate increase on economies? What is the cost that inflation, because of COVID, because of supply chain shocks, because of energy prices, what is that now going to do when people now have to start paying back the debt on their credit cards, on government debt, and so on? And so now what we're starting to see in the economy is that there's a worry that we're going to roll into a recession. I think we already saw some negative numbers in the United States on Q1. I think it was a decrease of 1.6% in GDP growth. And so the concern here now is a recession. And I don't want to say too much because you know me as well as anyone, Bill. I can talk about this for hours.
Yes.
But that's where we're at right now. That's kind of the tail of the tape.
And that's a good, great introduction. You provided a lot of meat there. So, maybe let me just summarize and make sure that, we're on the same page and it's clear for the audience. So obviously you mentioned many factors that are risks in the markets right now. So not only do we have a war, which is causing an energy crisis in Europe, and they're a basket case with debt, and they're trying to normalize to get to 0% interest rate. Maybe that's a red flag there all by itself. But anyway, and then on top of it, we have supply chain issues, we have out of control inflation. Central banks and governments are kind of stuck, not knowing fully what to do, other than like, let's raise interest rates, but that creates the potential of a serious recession. And there's already indicators. Of course, the big debate in the economic world today is, are we in a recession or not? Most by definition would agree we're in a recession, based on 2 quarters, so forth, that we've had negative GDP growth. And so that seems inevitable. So that's kind of, I think, big picture. You've actually talked about a lot of the risks and in the global markets. So maybe let's transition to the next question is, what areas of the market do you like and see value right now in the midst of all this chaos? I mean, that famous word that we've heard like a gazillion times in the last 2 years is unprecedented. I think you used that a couple times in your introduction. But in this world where things are, incredibly lots of challenges, where do you see value? And in the markets, what are things you like in this environment?
Yeah, I think where you need to look for value right now in your portfolio should be in defensive positions. In our own portfolio, we have utility companies, we have well-capitalized financial companies that will do well as interest rates increase. We have companies that pay solid dividends. We have companies that are consumer staples. So the Loblaws of the world, the Sobeys, Metro, that is, the Aliments Couche-Tards, which feature in our portfolios as well. These are names that, I've often told people, there's never, what we can never guarantee an investor is that they're never going to see their balance drop. But you know, one of the things that we try to focus on all the time is to buy good quality companies
Yes.
that should we go into an environment where we are in a recession or there are dire consequences brought on by credit issues around the world. And I might add that, you know, the major economic issues that tend to plague economies through history is credit, right? So
Right.
that's something to keep an eye on. But what we want to be able to achieve are investments in companies that are well capitalized, that have great business models, that make a lot of money, but not only just make a lot of money, they pay that money to investors in dividends.
Yeah.
And
Yeah.
so, you know, going back to my point about portfolios dropping when the markets drop, at least you're invested in positions that pay you to wait. Or, you know, if you're an income investor and you're seeking cash flow, you
Right.
know, you're not necessarily so concerned about what the daily value of your portfolio is, more so than on a monthly basis, you're getting your check paid to you. So going back to what we're talking about, I like utility companies. I like, you know, staple companies, consumer staple companies, companies that if the stock exchange, you know, were to shut down tomorrow, people are still going to go out and have to buy their, you know, their prescription drugs, their groceries. They're going to have to pay the heating bill. They're going to have to pay their bell bill. Those are the types of companies we like to own. On top of that, where I do see additional value that investors can take advantage of, we can all agree after, you know, watching the market right now, that we're in a period of high volatility.
Yes.
So, you know, you talk to option traders and that's where they make their money, when there's a lot of volatility in the markets. And volatility also helps those individuals who want to dampen or perhaps maybe increase the amount of income that they receive from their portfolios. So strategies like covered call writing, excellent at this point in time, because you have volatility that spikes, which causes option premiums to increase. And when you own a company and you write an option on that company, you're capturing a larger and larger premium as volatilities get higher and higher. And if you're concerned about income, and again, not so much that, you know, your portfolio is valued X and Y at any given day, that's a great strategy right now. And those types of strategies also, you know, the strategies that focus on developing a cash flow also tend to be less volatile than the broader market. So
Mhm.
that's where I see value
Value.
right
Yeah.
now in
Okay.
equity markets and strategies. Yeah.
So it's really important to be in the right sectors and at this time be defensive. And so are you deploying hedging strategies at this point in your portfolio?
Yeah, you know, and I hedging strategies. It's funny that we sometimes we talk about these hedging strategies and people think, well, wow, you know, that's a novel way of doing it, Mark. You know what you've described. Your first basic hedging strategy, and everyone should always,
Okay.
before you think about allocating any money, everyone should always think about how I diversify a portfolio. Plain
Right.
and simple. That's your first hedging strategy from day one, even before you think about
Yeah.
where am I going to allocate to a certain particular stock. So rule number one, what I want to be able to see in a portfolio is we do have cash on hand right now.
Yeah.
We have made steps into the market to take positions in the past little while. You know, it's always better to buy in a market that's come off. So we've
Yes.
done that. And then on top of that, you want to hold positions that are well diversified and
Yeah.
uncorrelated. So positions like commodities, covered call writing, which focuses on the volatility,
Yes.
to broad-based equity exposure. Also, you want to incorporate positions that might have some fixed income in them as well, because I think that we may be in a position here to see interest rates having to stop increasing, because we may be at the point here where so much damage has been done to economies that
Right.
conceivably central banks around the world might not be able to increase interest rates anymore because of so much potential negative growth.
Well, yeah, and that's clearly been a big debate, amongst analysts all over the world, like, how far will the Fed go, and of course, all the other central banks will follow. Like, some believe they'll go as far to break something, that like things are going to get really painful, and then others think, oh no, they're not going to do that. So I guess we'll find out, but clearly they're still indicating they're going to continue to raise rates for the foreseeable future. So we'll see how it all plays out. Well, let's kind of maybe transition to, you kind of talked about things that you do like. Where do you see things that you would really want to avoid at this point in the market cycle, and assets? Again, I mentioned the importance of picking sectors is really important in this type of environment because there's so many dynamics going on. But what would be the areas, just in brief, that you feel you should avoid at this time?
Right now, I do have some concern about the Chinese economy.
Yeah.
So those individuals who are looking to allocate and get exposure to baskets of emerging markets that have a large component invested in China, primarily because of the real estate.
Yes.
I certainly believe that there is a real estate bubble in China. I
Yeah.
believe that there's it's the capital, the credit situation in China is one that's quite worrisome, and they go hand in hand in terms of real estate. There's been a lot of speculation right now in terms of investing in Chinese real estate. That air is going to come out of that bubble fairly quickly. There's going to be a knock-on effect to that.
Right.
So that's my biggest concern. That also leads me to other concerns like the Eurozone.
Yeah.
And so Eurozone debt is one of the things that we should constantly watch. And so I always say you want to be diversified, right? That's your first strategy to hedging any of this major volatility. But the next one is, once you see major credit issues, cash is a great asset class, okay?
Right. Yeah.
And a lot of people, will say, well, inflation's going higher, and I don't want to lose buying power. But for the 3 or 4 or 5 months that might be a major drop in portfolio or in markets, holding cash is not a bad idea either. So my concern is China, Eurozone credit issues, and whether that, there could be a contagion that spreads out from there.
Yeah. Well, clearly, emerging markets have borrowed trillions, tens of trillions in US dollars. And of course, the US dollar has been exceptionally strong the last, year, especially this year. And, they've got to pay back when their debt comes in their, they have to convert their dollars, which have been crashing. So that's another real concern, because most currencies, I mean, look at the euro, and I mean, that's outside emerging markets, but look at the euro, it's gone down to parity with the US dollar. But a lot of these emerging market countries, I mean, their currencies have just been trashed because of too much money printing. And obviously, we've done no better here in North America, especially under our current administration. They, both US or Canada, they seem to love printing money like drunken sailors. But anyway, so that's another area too that I think which creates concern. Again, back to your point about credit, like
Right.
when you have too much credit, that's got to be paid back. And countries are scrambling to have to print more money in their own currency, which devalues it further, just to be able to start paying back these debts. So it's quite a quagmire they've created.
Yeah, and the other part of it here, folks might say, well, why would you still be keen on commodities if the US dollar is as strong? And the reason being is, I think, for a certain extent, that strength in the US dollar is very short term.
Right.
Because I think what will happen is most investors will come to the realization that the U.S. isn't in any better position than most economies are, and at that certain point, that's going to have to be observable in the dollar coming off as well. And so when the dollar comes off, you'll find that commodities tend to do better. Gold, silver, precious metals tend to do better when the U.S. dollar comes off. But yeah, your point is well taken. Credit had, when you go back in history and you view major market moving events, the ones that we all remember stem from credit.
Too much debt, yeah.
Yeah, so 2008, long-term capital management. These are the things that really move markets and have the ability to have a significant contagion that needs to be sussed out. Yeah.
And I think, to your point, there's lots of risks right now in the markets, and we're not out of this yet. I don't think, it's whether, and, a lot of talk too is around stagnation. The event of the 70s seems to be reoccurring. I mean, the only of the three amigos that define stagflation, we already have, recession happening. We have high inflation, so slowing economic growth. We have, and then of course they're raising interest rates, so we have raging inflation on top of it. The next one is unemployment, and we're already starting to see that start to play out in major Fortune 500 in the U.S., especially in the tech sector, and actually even like Walmart, like companies you wouldn't think they would be laying people off, but there's been some actually. Despite your earlier comment saying that economic or the employment looks so strong, but it seems like that's starting to wane as well. So I think that's another risk, and which I'll transition to our next question. But I think the combination of super high inflation, of course, we have also the extreme high fuel prices, which was also another issue in the 70s. Different circumstance, but fundamentally same thing happened. Super high fuel costs, and then eventually too you get a lot of social unrest when everything's so expensive, and that we're also seeing in spades in nations all over the world. Like there's a lot of protests and a lot of the media is trying to keep it hush hush, but fundamentally there's well over a dozen countries that have serious protests to rioting, so because everything's getting unaffordable, right?
And I like your you bringing up the 1970s. There are great interviews that you can watch again on YouTube or whatever media source that you use, of Paul Volcker, who happened to be the Federal Reserve, and many say one of the best Federal Reserve chairmen that the United States has ever had, and Paul was charged with the task of breaking the back of inflation. Yeah. And so inflation was incredibly high in the 1970s. Yeah. Unemployment, 15%. Yeah, absolutely. Unemployment was awful. We had the energy crisis coming out of 1980. And so Paul Volcker, if you listen to a lot of those interviews, he said he had to, he said that if we did nothing, inflation would crush us, and if we did something, at least it's more of a controlled demolition of destruction, and at least we're pulling the levers. And what I would say though is that there is a bright spot to this, that typically when interest rates start to rise, you'll see the effects. They're muted at first, but then you'll see them on a lag basis. I think we're starting to see that, as you've already talked about, many of these companies are reassessing how much reinvestment they're making into themselves. They're trying to get to a leaner balance sheet, leaner income statement, and because of that, what tends to happen is you get layoffs. So although that's not a good thing, that's certainly what central banks are looking for when they're increasing their interest rates. So this may be an indication. All is not lost. We've been in worse times before, definitely. I would say the 80s was probably worse than we are today. So employment does kind of remain strong, as long as we see interest rates doing some of the work. A lot of the pressure that you're seeing in equities right now is driven by fears of inflation,
Yeah.
fears of higher and higher and higher interest rates. And if we see the Federal Reserve, if we see the Bank of Canada in the next couple of meetings start to suggest that, well, things are working, there's going to be less surprises along the way. I think what you're going to see is some level or floor here be put into the stock market, maybe just a little bit more confidence that it might not be as bad as it could be.
Well, it's interesting though, like Paul Volcker, he actually increased the Fed's rate over inflation. I mean, today, of course, the dynamics are extremely different. Back then, the global debt was like 35% of the GDP. Now we're at 140 or 30, 40, whatever it is. So if they were to repeat Paul Volcker's playbook, they would have to, increase interest rates to well over 8, 9, 10% just to contain. And we know they can't do that because there's so much debt. So it's kind of put them in a pickle. And I think, it's not going to be a soft landing as, everyone hopes for. Potentially, we'll see. I mean, you hope it's not devastating, but central banks always are behind the curve as far as responding. They're always looking in the rear view mirror at their data instead of, grasping the big picture. But anyway, so it's interesting times.
They never seem to get it right, do they?
No, they're always reacting instead of being proactive, and it's in essence, many analysts will say, well, it's the Fed that and central banks who create these problems in the first place. Right. But anyway, that's for another discussion, another day. So let's. So average person, maybe your family or a friend comes up to you and say, Mark, what are things I should do? Right now, like, just for an average Canadian, what are things I should do personally to, kind of protect my family, my wealth? What would be some recommendations you'd make to them at this point?
That from a portfolio perspective, I can talk about that. I've always said it's about debt.
Right.
Own yourself. Don't let other people own you.
Correct.
And especially and you as a planner who've had the experience you've had with people on a daily basis. Now that's the first thing. Ensure that you're not burdened by debt. Ensure that you have money tucked away, that if circumstances change in your life, that you have an ability to absorb unexpected expenses. Those are the first priorities before you look at trying to generate additional wealth on top.
Yeah,
so that's a starting point for everyone.
That's a great point, and I emphasize that a lot with clients. Have no debt or limit. Try to reduce it as quickly as possible, because in this environment with rising interest rates, already actually we're at record levels. I don't know if you know that Canadians are like distressed with their debt levels. You're starting to see bankruptcies actually hit record levels again. So it's already impacting people. To your point, carrying debt, debt is not your friend. Yes, if it's used properly, yes, leverage can work if you know what you're doing. But I know there's a big debate. Robert Kiyosaki, of course, the famous Rich Dad Poor Dad. That's how he's built his fortunes, using debt. Loves debt, but he's very sophisticated. Has a whole team of lawyers and accountants and specialists. He knows what he's doing. The average person, and I sit down with, could be average, ordinary, working class to multi-millionaires. And, the overwhelming thing I say is, stay out of debt, reduce debt, because unless you really know what you're doing, it's a dragon when it's released, and we're seeing that already, like in China, right? All the debt defaults, everything's wonderful when the government is, printing money, or fiscal and central banks, but when they reverse course, which happened this year, in most, China is actually different. They're replacing, kind of going back to the U.S. model of printing money, but ironically, yeah, it's, to your point, I think it's bang on. Debt is not your friend in most cases. Again, if it's used properly if you're a sophisticated, investor, business person, yes, you can use it. But for most people, it's not gonna benefit them long term.
And the myopic nature that frames our decision making for parameters of investment doesn't allow us to be objective about how debt works. For the past 32, 35 years, we've been in the greatest bull market for bonds that there's ever been. Why has that been the case?
Yeah.
Because interest rates were doing one thing and they were going down. And that's why people's houses went up. That's why if you owned a bond portfolio, it went up. That's why if you owned high-paying dividend stocks, they went up, because as interest rates drop, these things become more valuable. Well, guess what happens when interest rates start to go up again? Sorry, when they go down, they become more valuable. When they go up, you're going to have to deal with
and we're already starting to see that in the Canadian real estate, where it's starting to be in trouble, and there's clear indication that the market's reversing, and all bubbles have to deflate eventually, and we clearly had one. Hey, so let's kind of wrap this up and kind of talk about your closing thoughts, but also, and then we'll end it with, what services do you provide as a company to Canadians? Like what is your specialty? I mean, every firm, you're a boutique firm, but what are the things you offer Canadians? And then I'll maybe talk about how I work with you and how we can help potential clients. So any closing thoughts, and then we'll transition to kind of what your services are to Canadians.
The only thing I can ever tell people when they look at their investments is just be well diversified. Don't get caught up in listening to talking heads, buying and selling stock on the news channels every day, because you can watch in the morning and the same analyst who says this stock is a buy, or portfolio manager says this stock is a buy, you'll have another one in the evening say, you know what, I'm not touching it. So the fact of the matter is that you have to build well diversified portfolios, because that protects you from being wrong. And then on top of that, you want to have someone who's looking after your affairs, like Bill, like myself, will be able to help you allocate your portfolio properly. Bill, you'll talk about your services, but those are the types of things that you want to focus on as an investor. Make sure you're well diversified. Make sure you have individuals who are looking after your portfolio on a daily basis, and you've got most of your objective met at that point.
And I think that's a good point, because the vast majority of Canadians have their money passively managed. They're in a portfolio. It's just, it's not actively managed. There's not people actually taking care or rebalancing. Sometimes, I don't know how active your management is, meaning, but I know on a dime, you can change things if you feel, the necessity. You can take different positions into different asset classes when you feel it's appropriate to the risk of the portfolio. So yeah, let's kind of then, your specialty, and what are the things, Excellent Capital, Excellent Select, you specifically, what can you offer Canadians as a portfolio manager?
When we started this firm, our focus has always been on working with a specific segment of Canadians, and that's somewhat unusual. I think you would find in the markets. We're just not going to work with everyone. What we've found is that we want to concentrate on people who are pre-retirees and retirees, and we want to be able to help those individuals maximize their objectives and reach the end of the road. That's not to say we can't help people who are younger or older. It's that this was always our company was always designed to try to achieve the best outcome for those people. So that's the first thing, I think.
Okay.
And
So,
then
so
the way
your
that,
target markets kind of 50s, 60s, maybe 70s, that kind of that's
yeah,
kind of your,
I would call them pre-retirees, retirees.
okay.
They're individuals who, when they sit across the table from me, they'll say, Mark, you know what, this is 30, 40 years of our nest egg.
Yeah.
Don't blow it up.
Yes.
Please,
Yeah. Good point.
make sure it's there, manage it as if it was your own, manage it as if it was a pension for us. And then when it comes time where we pick up the phone and we call you, we'd like to receive that monthly check, and we don't want to lose a lot of sleep at night.
Yeah.
That's what people want when they come to us, and that's the type of service that we want to provide.
So you're not doing the Kathy Wood management style.
No,
Swinging
no.
for-
At the end of the day, I've been doing this far too long, and I've seen far too many people get caught up. Again, we talk about the myopic nature of investment making,
Right.
investment decision making, and I've just seen it for far too long. Those people who have reasonable yearly returns with muted downside when the market hits, when it goes south, those are the people who end up getting to where they need to be in the end.
Yeah.
And so that's the type of portfolio that I want to run.
So it's kind of the old hare and tortoise strategy,
Absolutely.
right? Some people are swinging for the rafters, and again, I don't want to, Kathy Wood, a nice woman, but she swings for the rafters. She's doing the sprint, right? Where you're taking more the tortoise route and just slow and steady and being defensive all along the journey, being very defensive. You're not trying to get, 200, 500% returns in a year.
but you know what though, and that's a great point, Phil.
Yeah.
There needs to be a distinction. I'm a portfolio manager. I manage portfolios. I don't just pick stock.
Yeah.
Okay. There are people who are out there who pick stock, and that's great. That's what they do. They have a specific strategy. A Kathy Woods has a specific strategy. And guess what? I can actually see her strategy maybe fitting at some point in a portfolio.
Okay. Yeah.
You get what I'm saying?
Yes, I do. As a portion of it. Yeah. As a portion. Yeah.
There's a major distinction. And that's, what I always try to educate people about is, they like to talk stock and how are you picking stock and which stocks do you pick? And I always have to reel them back in and say, that's not the most important part by a long shot. It's about building a good portfolio.
Yeah, oh, that's a great point. So you do, you're pre-retiree, retired, who want to really protect their assets. Is there any other services you provide to Canadians, your expertise?
You know what, we provide primarily just in portfolio management. We work with individuals like you. I kind of use the analogy that clients come to you and they should view you almost as their family physician for finance, right? So you'll know them from head to toe, and you'll recognize with working with them that they require a specific special need for investment management, portfolio management, and that's where you would refer them off to an individual like myself. So I work with individuals like you who provide that service.
Yeah, that's awesome. Yeah, and just as a note, I do have a referral arrangement with Mark and with his company, and I don't get a commission up front. There's a trailer arrangement, but that's how we're compensated. And so anyway, well, you know what? It's been a great discussion here this morning, and lots of good commentary, thoughts, and I always appreciate, Mark, you taking time. We talk quite regularly, and so it's always great to chat with you and kind of get your perspective and share ideas. And so thank you so much for taking your valuable time out of a Saturday for the audience. And I'm sure out of this, we'll have some people reach out, and possibly, I'll be able to do some introductions to you in the near future. So again, thanks a lot, Mark, for all that you do. And I really appreciate your friendship and your, how seriously you take managing money and protecting clients' wealth. So that's one thing I really appreciate about you.
Thanks, Bill. It's been fun.
All right. Have a great rest of the Saturday.
Thank you.
Take care.